work this if it works. We turn to a topic now that is very near and dear to my heart. I mean, I love mobile payments overall. I mean, this is just the coolest area. I got into it, believe it or not, from the payphone industry. And unlike the payphone industry, I think mobile payments has a bright future ahead of it. One of the reasons that privacy and data security is so near and dear to my heart is I've literally had to get a new, and David, you ought to come down and get queued up here. I've had a new credit card issued to me approximately 1 to 2 times a year for about the last half a dozen years, either because of actual fraud or because my issuer felt that my card had somehow been compromised. So the last time it happened, okay, I mean, on the bright side, I haven't lost a single dollar. The issuing bank or the card network has taken care of that as they should. But it's a huge inconvenience, and consumers who go through this experience know what I'm talking about. But the last time it happened to me, I was actually on vacation, and so I got a text message from Visa or my bank and said, your card's been shut off due to fraud. And I called them up and I said, this is a real problem. I'm on vacation. They said, oh, don't worry, sir. We'll FedEx a card to you and you'll have it tomorrow. And I said, no, I don't think so. You don't understand. I'm on vacation. And they said, well, FedEx goes anywhere in the world. Tell me where you are. And I said, well, I'm on a cruise ship halfway between Los Angeles and Hawaii. And I don't think FedEx offers next day delivery to where I am. And so for the next almost 2 weeks, I had to explain to the cruise ship purser every day why my card was getting rejected, and I had to try and rent cars on 4 islands in Hawaii without a credit card. It's a real challenge. And then, of course, when I got back, I had to update all of my online accounts with the new credit card. So there must be a better way, and hopefully our first speaker can address how we're going to be able to cut down on some of the fraud problems. Refer you to the book for all of the bios, but our first speaker for this panel is David Newville with the U.S. Treasury Department, and David has about a 10-minute, 15-minute presentation for us. David, please welcome David Newville.
Thank you, everyone. Everyone hear me all right? I don't know if I have a solution to your problem, Brooks, but I have a feeling that drones might be involved someday. Yeah. I'm sure Amazon's definitely working on it, probably FedEx as well. So to change gears from the previous session a little bit, I'm going to talk a little bit more about domestic issues, domestic financial inclusion. We'll definitely talk about a lot of the work we're doing at the Treasury Department right now, particularly around cybersecurity issues. But then coming back to Treasury's larger role as a major payer, obviously working with the administration on policy issues as well. I'm on the domestic side of Treasury. I'm in the Office of Consumer Policy. I help lead our payments work in the Office of Consumer Policy. So my knowledge is specialized in that area, and I'll address those. So I will give some brief remarks. I'll take us through kind of some of the work that we're doing, and then I believe we'll have the panel, and then I'll stick around for any questions during the Q&A portion. So. First off, thank you for having me here. Like I said, it's great to be here today to talk about some of Treasury's work. One of our goals at Treasury is to identify and support policies that promote a financial system that empowers families to move up the economic ladder. We recognize that electronic accounts and payments innovations are important tools that can help improve Americans' financial access and well-being, and this is one of our major priority areas. This is an exciting time in the evolution of payments, as we all know, from the rise of prepaid cards, which used to be considered the innovation, at least in the United States, in payments, to the promising growth of mobile payments, as to the yet to be fully understood and appreciated opportunities of virtual currencies and related innovations. Times are most certainly changing. Most of our work in this area that we've been focused on, at least looking backwards, is around GPR prepaid cards. And let's take a look at them. Transaction amounts have grown from next to nothing, at least domestically in 2000, to slightly more than 200 billion as of 2012. Analysis suggests that the market will grow to approximately 700 billion by 2020 here. Mobile payments are expected to grow significantly too, with mobile transactions growing between 30 to 40% over the next few years, amounting to approximately $500 to $600 billion. This event brings the many consumer and economic opportunities and risks that arise with electronic payments to the forefront. We all recognize payments, innovations, and products can open new avenues for fraud and abuse, and they may create consumer protection gaps. Addressing those gaps and getting the issues right is important to us because we recognize payment innovations have the potential to advance so many goals that we are passionate about. Goals such as furthering financial innovations, particularly those that enable consumers to become better managers of their money, expanding financial access, and stimulating economic growth overall. To begin this conversation, let me talk about why Treasury sees this as an opportunity for growth and what exactly we're doing in this area. Increasing consumer financial access is of great importance for Treasury. Not only is financial inclusion an important goal in and of itself, but financial exclusion can obviously be a factor in preventing families from reaching their full economic potential. Improving access to financial services for the financially underserved gives them more possibilities to create economic opportunities. It also allows them to transact safely, conveniently, and inexpensively, and to make sound financial choices such as saving more, building more assets, and gaining access to safe and affordable credit by creating positive credit histories. From a broader macroeconomic perspective, studies suggest financial inclusion can have a direct bearing on economic growth, and the absence of financial inclusion can contribute to persistent income inequality, particularly among women. Moreover, those same studies show that greater financial inclusion is correlated with higher living standards, better health outcomes, higher education levels, and an overall improvement in financial health. We recognize that payment innovations and the use of data and mobile devices may help millions of financially underserved individuals access financial services and improve their financial well-being. For those who have a low or no-cost bank account, the ease and affordability of everyday activities such as making purchases with a debit or credit card or having paychecks directly deposited in their checking account is often taken for granted. Not all Americans have access to these services. In fact, the FDIC found in its latest survey that 17 million Americans are unbanked. Another 51 million Americans are underbanked, which is defined as those who have bank accounts but rely on alternative financial products and services, which may be high costs to meet some of their transaction and credit needs. Notably, the study also found that many of these consumers are turning to prepaid card accounts to spend, save, and manage their money. The FDIC found that prepaid card accounts are a popular product among unbanked households. This confirms the results of a recent report by the Pew Charitable Trusts, which found that over 12 million Americans use prepaid card accounts at least once a month. According to that report, 44% of regular prepaid card account users do not have checking accounts, and 33% never had credit cards. Financial service products that leverage electronic payment capabilities, particularly those that build on prepaid card accounts, demonstrate powerful opportunities to help meet the financial needs of underserved consumers and provide access to the financial mainstream. New entrants, such as technology companies, have been developing prepaid card accounts and other payments products that have similar and even improved benefits compared to bank accounts, and they allow providers to serve and underbanked consumers financially sustainably. And as most of you know, payments technologies are rapidly changing in the face of financial services across the globe, allowing the financial sector to reach more people in more remote places and at lower delivery costs than ever before. Such advances are enabling new business models and creating a capacity for remarkable change in terms of cost and ability to reach scale. So now I want to shift, and I'm going to talk a little bit about how we at Treasury are specifically using prepaid card accounts and payments innovations. Then I will also discuss what we are doing to help drive industry changes to promote safety and cybersecurity, and address some of the challenges facing innovators and payments firms like de-risking. And then lastly, I'll discuss our support for consumer benefiting innovations in the payments market through our Financial Empowerment Innovation Fund. So to start, you may or may not know that Treasury is one of the biggest issuers and distributors of prepaid cards in the United States through our Direct Express program and a couple other card programs as well. Direct Express is a prepaid card program for unbanked federal benefit recipients. As of the 1990s, we were sending out entitlement checks on a monthly basis to millions of households across the country. Spurred on by Congress to go electronic and given by our interest in reducing the financial and fraud costs associated with paper checks, we turned to prepaid cards to help provide accounts to millions of unbanked households receiving these benefits. Before turning to prepaid card accounts, we tried a few strategies to encourage banks to offer low-cost accounts for the purpose of receiving these funds, but the economics simply didn't work. We then realized that prepaid card accounts could sustainably allow us to distribute federal benefits into safe and consumer-protected accounts. We piloted prepaid cards with JP Morgan Chase in the 2000s, And prepaid cards are now the product we use to distribute federal funds to individuals who do not direct deposit their payments into a traditional bank account. Today, more than 5 million benefit recipients have enrolled in the program, and we consider our prepaid card program to be a tremendous success. Unbanked households are receiving their payments more safely, securely, and reliably, and those lacking a traditional bank or credit union account are not left out of the financial mainstream. Now we are starting to use technology, mobile phones, and behaviorally informed incentives to enhance the financial knowledge of Direct Express account holders. We're leveraging PayPerks, a startup that has delivered a system to use cash rewards to encourage Direct Express account holders to watch short online financial education modules that emphasize budgeting and using the cards wisely to manage transaction fees. As of this month, more than 380,000 Direct Express users have completed nearly 2.7 million modules through PayPerks. MasterCard, our network partner, has given out 53,894 cash prizes for a total of $94,395 as of March 1st of this year. We're also in the process of developing a mobile app for Direct Express account holders, and we continue to look for more ways to enhance the Direct Express account holder experience. In addition to our disbursement role, we also process billions of dollars in transactions between individuals and businesses and the government and the other way around. We work hard to ensure that these transactions are secure and that Americans have a range of methods to make payments to the government. Last fall, the President announced the Buy Secure initiative to advance payment security in the market broadly. As part of that effort, we announced that we are applying chip and PIN to newly issued and existing government credit cards, as well as our Direct Express prepaid cards. We are also upgrading our retail payment card terminals to accept chip and PIN enabled cards. Additionally, Treasury is focused on ensuring that government's federal benefit payment cards and terminals are capable of using other newer payments technologies as well. Apple Pay is one payment innovation we're exploring, and the tokenization with that product is particularly compelling. We're making headway on other fronts too. In fact, we are now allowing individuals and businesses to make payments to the federal government through PayPal and Dwolla. And you can appreciate where these payments innovations are especially helpful for the millions of underbanked Americans who don't have access to bank accounts through which to send payments to the government in the first place. In addition to improving the security for our own payments products, enhancing cybersecurity at large is a top priority for us and our partners throughout the federal government. My colleagues in the Office of Critical Infrastructure at Treasury are working with the financial sector to encourage institutions to adopt proven cybersecurity best practices, coordinate cyber threat information sharing, and support cyber incident response and recovery procedures. The security of our financial sector is a shared responsibility, and everyone has a role to play. In our interconnected world, promoting cybersecurity requires that we all work together with strong communication and cooperation. At Treasury, we believe that this kind of teamwork is fundamental to confronting the ever-changing cybersecurity risks that our nation faces today. This is at the top of the agenda for Treasury's Deputy Secretary, Sarah Bloom-Raskin, who's been leading this issue within Treasury and will continue to do so. Another component of Treasury's work involves engagement with state, federal, and international financial regulators and policymakers to foster financial inclusion, combat money laundering, and terrorist financing. Treasury's Office of Terrorism and Financial Intelligence, or TFI, leads intergovernmental efforts to establish domestic and international standards for the regulation and supervision of money transmitters and other money services businesses, or MSBs. Millions of Americans use MSBs to pay bills, cash checks, exchange currency, and send funds to family members and friends both domestically and all over the world. Over 1/4 of U.S. households use non-bank financial institutions, including money transmitters. Ensuring the money transmitters continue to be able to send funds through legitimate and transparent channels requires an approach that balances the complementary goals of financial inclusion and financial transparency. To address these issues, my colleagues have actively engaged with and provided guidance to money transmitters and the communities they serve to explain their federal obligations. Treasury has also conducted outreach to banks to reiterate that providing services to MSBs is possible while still remaining in compliance with the Bank Secrecy Act. Just a few weeks ago, we convened a roundtable on financial access for MSBs to engage with industry stakeholders, share policy priorities, clarify regulatory expectations, and hear firsthand about how financial access for MSBs has evolved. I recognize that de-risking is an important issue for many of you, and Treasury is committed to playing a constructive role in that dialogue and working with other parts of the United States government to address this. The last topic I want to touch on is our Financial Empowerment Innovation Fund. To spur innovation and new ideas in consumer financial services and to inform and influence policy, last fall, Treasury launched the Financial Empowerment Innovation Fund. We are currently funding 11 multi-year research projects focused on improving financial health of Americans and drawing attention to the ways that technology and data can improve consumers' financial lives. To give a brief flavor of the research projects we're funding, one is with a company called Banking Up, a prepaid card company, to evaluate how prepaid cards linked to savings accounts and PFM tools can help underserved consumers to access credit and build their credit histories. We're also funding a project in San Francisco to connect public housing residents with prepaid cards that can be used to improve timely rental payments and potentially improve their credit scores in the process as well. We have an array of projects which are drawing attention to the many ways that innovators in payments, financial decision-making, and higher education are helping Americans improve their financial lives. To learn more about this fund and the other projects we're funding, please go to our website, treasury.gov. In closing, I'd like to say that Treasury is committed to supporting and leveraging payments innovations to help improve Americans' financial access and financial well-being, as well as the security of our financial system. Thank you for the opportunity to speak. Thank you for the opportunity to speak with you today, and I look forward to hearing your questions later.
Thank you very much, David. So without too much ado, where is Louis? Come on down, please. Our next speaker is Louis Koker, who undoubtedly wins the prize for traveling the longest distance. He's come to us from the land down under, Australia. To give you an idea how far away it is, Louis' biological time clock is actually set to tomorrow. So please welcome Louis Koker.
Thank you, Greg.
You're welcome.
Now I need some assistance, please.
Which one's yours? This way. Sorry, I'm blind. It happens.
And how do
If you
I...
just left click the mouse or the right to advance
beautiful.
on the keyboard.
Thank you so much. Ladies and gentlemen, to Leon, thank you very much for the invitation. To you all, I am very alive to the fact that I'm standing between you and afternoon coffee. And I'm, Brooks, please provide me with time indications. I'll try to be as disciplined as possible, because I feel very passionate about this topic. And I would like to locate it within the context of this particular discussion, because I think it's very important that we tackle this issue in a multidisciplinary way, drawing on the strengths of all of the various streams involved in the development of digital financial services for those who are currently excluded. There's currently a high level of interest in customer data held within and generated by digital financial services. UN Pulse, for instance, is very involved from a data for development perspective. World Economic Forum is involved. GSMA, and this is just touching on some of the organizations involved today, the Data Pop Alliance. There are others, of course, Privacy International, the Global Information Society, Watch, Right to Know in various guises in various countries. It's a huge and complex legal issue. To keep it contained and to focus on some of the harder aspects, I'm focusing specifically for purposes of this discussion on law enforcement access. And I thought to focus it just on one region that is of particular importance and was mentioned a couple of times today, Sub-Saharan Africa, to include West, Eastern, and Southern Africa. Starting with the general data, the hardcore data in the digital financial services channel includes financial information. And financial information, we know, I'm not going to speak as a lawyer because it's a multidisciplinary audience, but we know our financial information is confidential. And many of you may be familiar with the term that developed during the course of the 20th century, bank secrecy. We're aware of the fact that bankers have to safeguard the confidentiality of that information. And that reached a high point in the mid-20th century, and that was particularly attractive to criminals who started to abuse it. As a result, several steps were taken to start whittling away bank secrecy. One was actually taken in 1970 in the US with the adoption of the Bank Secrecy Act that actually does not safeguard bank secrecy. It stripped it because it introduced a number of disclosure obligations. And it set the scene for what we now refer to as the International Anti-Money Laundering Framework that took shape in 1989 with the adoption of the Financial Action Task Force standards. Now, these often feature in these discussions. David also referred to anti-money laundering. Our focus often falls on KYC, the Know Your Customer obligations, customer identification, because it forms such a significant barrier in many cases to people who are outside of the banking system and who lack the required verification documentation to be able to gain access to the financial system by passing the identification verification obligations that were imposed on financial institutions. I'm not going to discuss that in detail. It's just the personal information that enters the channel. But behind that is something that we don't often discuss in financial inclusion discussions, and that is the monitoring obligations. Once you have a customer on board, you have legal obligations to monitor the customer's transaction patterns. Why? To identify unusual or suspicious transactions that may point to criminality. Why? Because there's an additional serious obligation to report those. To report them confidentially. You may not leak any information to the customer. This must happen confidentially. Reports have to be filed with a financial intelligence unit that appears in different forms and shapes in more than 180 countries around the world. And in addition, there may be other reporting obligations. Cash transaction reports, starting in the US, has also taken hold internationally and are now found in many countries, so that it's not only transactions that are suspicious that must be reported, but also those that involve amounts of cash in excess of a stated threshold, whether or not they involve any suspicious activity. And that is the basic shape of the AML CFT, anti-money laundering, combating of financing of terror, information gathering and disclosure obligations. That's not the full extent of it, because if there are investigations into any of these transactions, then there are obligations to disclose even more information. I'm not going to go into that level of detail for this paper. That is the one leg of digital financial services. And it's important, the money laundering and terror financing control framework does not only apply to banks, it applies to financial activity, irrespective of the type of entity that conducts the stated financial activity. And it basically encompasses most of what we would find as service delivery within the digital financial services space, unless it's only merely messaging services. The other channel, of course, is the communication side. Now, our communication information is also generally confidential, but can be accessed on good grounds by law enforcement. And it's helpful, at least as a starting point, to distinguish between the metadata, the call data, the data that a communication took place, and the actual communication itself. I'm sure you're all familiar with wiretapping. That's accessing the actual account, the actual call. That is normally available only upon a court-ordered warrant or subpoena, and these are known by different names in different systems in different countries. The metadata, on the other hand, also requires some form of approval, but we've generally seen the approval levels being eroded. Australia, for instance, in the past months adopted a new act on access to metadata relating to communications, where senior officials, about 2,500 of them, can give the go-ahead for any official to access any of our call data in Australia. Now, if you look at these two, generally, for some reason, financial data has been viewed by privacy experts as less sensitive than communication data. We're sensitive about people accessing our communication data. Somehow, although it's so revealing, there's never been a real pushback from civil society about the financial data side. So it's a more vulnerable aspect, and it's interesting that in digital financial services, this blend may lead to some bleeding, that some of the vulnerability of financial data may actually spread, because it's not clear where you draw the line between financial data and communication data in a digital financial services channel. Geolocational data, for instance, that's generated. Is that financial data or is it communication data? Because the location can be very revealing and can be very helpful to monitor account activity for suspicious criminal activity, and is used in fraud controls generally. Now, to move on to some statistics, to get a sense of what's happening. That's data of a number of African countries. They are not easy to come by, but I thought those would provide a snapshot of what's happening. First column, STRs, that's suspicious transaction reports. 347 in Ghana, 201 in Kenya, nothing spectacular. 355,369 in South Africa. I'll come back to these. This is the suspicious transaction reporting channel. The cash transaction reporting channel is interesting. Cash transaction reports in Ghana, more than 1.3 million. Now, in Ghana, transactions involving more than 5,200 US dollars need to be reported. So that's reflected in those statistics. Nigeria, 3.8 million. South Africa, 6.1 million. So there's a significant amount of money, of data flowing to government in relation to cash transactions. And that information is required for data mining purposes by government. The suspicious transaction reports don't, on the statistics, give rise to concern outside of South Africa. They look fairly conservative, but unfortunately the statistics are not disclosing the full information that we may be interested in. And a single suspicious transaction report may involve a raft of accounts and a raft of customers. So we're not quite sure precisely how to interpret those statistics. But one thing is of value. If we look at those statistics on suspicious transaction reports, they do not tend to decline over time. Again, South African statistics. In 2008, 2009, 6,000 reports, going up to 26,000, and then shooting up to 320,000. Now, that's a pretty dramatic shift. There are various reasons behind those shifts. Often it's a broader footprint of the law. Often it's linked to law enforcement. Fines have tremendous impact on compliance behavior in this space, because it's a trade-off that the institution has to make between the money it's got to pay and reporting customers that will not alert any customer because no one is going to know about it. It's all done confidentially. This system was created to combat money laundering, to combat organized crime, because it is such a huge issue to our society. So we would normally expect to see the huge rates of returns reflected in the number of enforcement actions taken on the basis of the data. Unfortunately, the correlation is not very strong. The 6,000 reports in 2009 in South Africa translated into 6 investigations. Not prosecutions, not convictions, investigations. And in 2013, the 70,000 reports into 37 investigations. So there's a huge social impairment to get the data, and the data is coming, it's there, but the purpose it's supposed to serve is not clearly being served by the system. That's on the financial side. What about the telecommunications side? Vodafone took, I would say, a very bold step last year by becoming the first global provider of communication services to issue a law enforcement disclosure report about the number of requests, warrants for information, releases that they received in the various countries in which they operate. The report is revealing for some of the aspects that is not being revealed because of legal obligations. On lawful interception, those are wiretaps. Most of the countries in Africa do not, where they operate, do not yet have the technical ability or have required them to put in the technical ability for wiretapping. Except South Africa, where it is in, but the law does not allow them to disclose that information. On data demand, so those are the call data records, the metadata. In many countries, the position is unclear. So in 2014, they've engaged the regulator. The regulator did not give them the go-ahead, except on Lesotho. So that's where the 488 comes from. And Tanzania, which is quite interesting, more than 98,765 such requests and disclosures. But on the other, we don't yet have a picture. We may have more of a picture in the next few months when they release the next annual report. This is, of course, not the full picture. We need to have a bit of context. Digital financial services are currently at the heart of a number of developments in developing countries. Think of SIM card registration program, something that has taken Africa by storm. Simone, that's taken from the GSMA, all of the blue, covered already by SIM card registration, where you have to provide identity details to gain access or retain your access to your mobile phone services. The increasing involvement and link between financial services and national identity programs of governments. Nigeria with a MasterCard branded national identity document scheme is an interesting one. And so is South Africa, where the banks are now involved in a piloting project where you apply for your national identity document at the bank. And then, of course, also mentioned this morning, but a far older link between banks and tax authorities, where banks had to disclose and have to disclose information about us to the tax authorities. And interestingly, M-Pesa, also in the same situation in Kenya. Now, in many of these countries, rules are unclear or absent, but we have cases where the rules are clear, but they're not being observed. State versus Agliati, one of the most important organized crime prosecutions in South Africa, failed. One, because the telecoms released very important call data without the necessary legal documents just on the promise that they'll apply for a warrant to authorize disclosure. After disclosure, the call data disappeared. Somehow, masses of it just got lost in the investigation. And furthermore, abuse of the system. Clearly, numbers were included in eventual warrants of people that should not have been included. So the whole legal team, together with family members and a few other lawyers that shared the same names as the defense legal team, were included in the warrant and had the call data released. This type of breach does not do anyone any good. The prosecution failed. To move towards a conclusion, digital financial services find itself embedded and enlisted in a system. This system and the access rules serve important public purposes. It also protects us. We need the data to be available, and in a prosecution, there's been many people who found their alibis supported by the call data that they could access. So it serves general interests. The question is figuring out how to get a balance, how to deal with it ethically, how to deal with legal obligations in countries also where the rule of law is weak. And there's a specific appeal there to international companies. A couple of things that I think should be done. Last slide. Data for development is attracting a lot of attention. But data for development also justifies, it provides justification for the gathering and retention of more data. I think it's important to consider and blend this into the discussion, because the more data you have on your customers, the more your legal liability is to ensure that you also use that data to identify suspicious transactions. You cannot have data that in your marketing purposes identified a criminal without having blended that into your suspicious transaction report. I think we need greater transparency, and Brooks, we need capacity building in these countries on ethics, on understanding of government and policymakers and role players, what the implications are. Thank you so much, Brooks, for your indulgence. I think I've stolen 2 minutes of your time.
So I noticed that we're the only panel that has a coffee break in the middle. I'm not sure what that says about us, but I do recommend decaf because we're going to have such a scintillating panel. I don't want you to be overstimulated. So please come back here at 4 o'clock to listen to our panel discussion. Thank you.